Hi, everybody. This is Alan Ellman, the Blue Collar Investor, and welcome to this BCI podcast number 30, titled, What are Cash Secured Call Options? How this strategy differs from covered call writing. Well, most of us are familiar with the term covered call writing, where call options are sold after purchasing the underlying security. It could be a stock, could be an exchange-traded fund. Most of us are also familiar with the term cash secured puts, where we sell a put option agreeing to buy a particular security at a particular price by a specific date. Certain amount of cash is set aside in our brokerage account in case those shares are in fact put to us. But what about cash secured call options? Kind of sounds like a meld of both of those strategies. But it's not. It's something different. So although we don't subscribe to this strategy in the BCI methodology, the fact that the term can be confusing with the other two terms, I thought I would dedicate a podcast to explaining how this strategy works with some specific examples of different strike prices. So let's define cash secured call options. This is a strategy where call options are purchased, giving the option holder or buyer the right but not the obligation to buy shares at the strike price by the expiration date. So we're buying a call option. We're long the call. Now for covered call writing, of course, we short the call. But in this particular strategy, we're long the call. Now because we may have decide to exercise and buy the shares at a specific price, we set aside a certain amount of cash in an interest-bearing brokerage account should we decide to exercise that option. As a call buyer, it is the decision of that call buyer whether or not to exercise. Now here are the strategy goals with cash secured calls. We're setting a maximum price for a particular stock that we are interested in. We have done our due diligence and we decided that this is a security that we'd like to own for our long-term portfolios. So that means that if we buy the call option, that we could buy it at the strike price, even if the price goes much higher. And if it doesn't supersede the strike price, we could buy it at the price lower than the strike price. So it does set a maximum price for a stock that we are interested in. But it also gives us the opportunity to reconsider the purchase of that stock. So whenever we buy that call option, we have from that point in time to 4 p.m. Eastern time on expiration Friday to make a final determination as to whether or not that is a security that we will purchase for our long-term portfolios. Now, there are three key threshold statistics that we must be aware of when using this strategy. First of all, the break-even price. So when we buy a call option and we pay a premium for it, the break-even is the strike price plus the premium. So as an example, as you'll see coming up, if we sell the $60 call option and pay $3 for that right, then our break-even is the strike 60 plus the premium 3, or $63. So profit begins above $63. Now the maximum loss is simply the amount that we paid for the call option. In that example, $3 would be our max loss. And finally, our maximum gain is unlimited, because once the price of the stock moves higher than the break-even, it can go to the moon. And all that would represent profit. So those are the three key thresholds that we must be aware of when we're using this strategy. So let's set up a hypothetical trade now. Let's assume that stock BCI is trading at $61. And we like the stock. We'd like to own it. So what we do is we buy a $60 strike, slightly in the money, call option, and let's say we pay $3. Now, we're long-term bullish on the stock, so that means that the most we'll pay for that particular stock is $60 plus the $3 premium. Our break even is $63. If BCI moves above $63, we start making a profit. What is our maximum loss? $3, what we paid for the call option, because we do not have to exercise that call option. We have until expiration Friday to make that determination. So let's take that information now and look at 4 different expiring prices for BCI as expiration is approaching, and let's see how each of these did relating to either just buying the stock at 61 when we made the trade, or buying the $60 call option at that point in time. So we're going to look at 4 different prices. We'll look at 65, which is $4 above current market value, which you recall is 61. We'll look at 63, which is $2 above current market value. We'll look at 60, which is $1 below current market value. And we'll look at 55, which is $6 below current market value. Let's analyze these 4 outcomes. Now let's assume for a moment the price of the stock at expiration is 65. Remember, our break even was 63, the 60 strike plus the $3 premium. That means we have a $2 benefit over the break even. However, if we purchased the shares at 61, we would have made $4. So we would have made $2 more purchasing the shares rather than the call option. Now let's take the second possibility. The strike price is at 63, which is the break-even price. So there's no benefit at that point in time. However, if we purchased the shares at 61 when the trade was executed, we would have actually made $2 per share, or $2 better than purchasing the call option. The third hypothetical price at expiration we're going to look at is $60, which is $1 less than when the trade was executed. So $60 is $3 below our break even, and that is our maximum loss. So we can't lose any more money than the $3 we paid for the call option. Now, had we purchased at 61, our loss would have been $1, which again is $2 better than had we purchased the call option. The fourth outcome we're going to analyze is if the stock price drops to 55. Well, this is $8 below our break even. But in this case, we would not exercise that option. We'd allow it to expire worthless. So our loss is the cost of the call option, or $3. Now, we can then purchase the shares at 55 if we're still bullish, which then makes our break even 55 plus the $3 we lost, or 58. So we're at a disadvantage of $3, our maximum loss on the call side. But had we purchased the shares at 61, that would represent a $6 loss. So $3 worse than had we purchased the call option. So in this particular case, purchasing the call option was a better outcome than purchasing the stock at 61. So to kind of evaluate and give an overview of this particular strategy, the cash secured call strategy is used to purchase a stock at the lower of the call strike or the current market value. So it sets a maximum price that the shares can be purchased at. It also gives us an opportunity to reevaluate our bullish assumption on that security from the time we buy the call option until 4 p.m. Eastern time when that contract expires. So it gives us a little flexibility before we enter a trade. Now, once again, this is not a strategy that we subscribe to in the BCI methodology. I'm not saying it's a poor strategy to consider. I'm just saying that I feel the strategies that we emphasize are strategies we could do much better at, which is covered call writing and selling cash secured puts. But certainly I'm not telling you not to look at it, evaluate it, and see if perhaps this is the right strategy for you and your family. But I did want to dedicate this podcast so that we can remove any of the misconceptions about this strategy and make sure you understand that it's different from traditional covered call writing or selling cash secured puts. And if you're looking for more information on those strategies, visit our store, www.thebluecollarinvestor.com/store. And we have a whole series of video lessons, ebooks, soft cover, hardcover books, calculators, and much, much more at that location. So I urge you to take advantage of these products, which will bring your knowledge of these option selling strategies to the highest possible levels. So that ends BCI podcast number 30. I want to thank everybody for taking the time to listen to this podcast. I hope you enjoyed it. And most importantly, hope it puts some cash in your pockets. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.